Welcome, my dear investors. Let's have a look at two dividend stocks on discount. My name is Thorsten Tiet. I'm the founder of Dividend-Stocks Cash. It's all about investing in high quality stocks to profit from long-term capital gains and growing dividends as well. So let's go. The first stock I have in store for you is called L3 Harris Technologies. It's a defense stock, aerospace and defense, and we all know that right now international security is a matter which got worse and worse. We have a full war in Ukraine going on, and the stocks like these in the defense industry, they potentially profit from this. I have Lockheed Martin introduced for the comparison here as well. Lockheed Martin is more popular for many investors than L3 Harris Technologies. But if you look at the growth of the revenue of sales, you will see that the revenue growth is much higher for L3 Harris Technologies than it is for Lockheed Martin. If you invested in any of these stocks, if you look back long ago, 5, 10, 15 years, you see that regarding capital gains, it's more or less indifferent, so it's basically the same. But L3 Harris Technologies is growing much more aggressively by mergers and acquisitions than Lockheed Martin does, and the dividend looks more attractive if you see how dividend increased last years from 1.3% to right now 2.34%, while the dividend of Lockheed Martin is more or less on the average, historic average. It is clearly increased for L3 Harris Technologies, although I do not hide it, the dividend yield, just if you compare it for Lockheed Martin, it's still higher than for L3 Harris Technologies. But, and I will show you, the valuation of L3 Harris Technologies is more attractive than the valuation of Lockheed Martin. But first, let's check the quality of L3 Harris Technologies. And we can see here that in 2019, revenue nearly tripled within 6 months, from June 2019 to December 2019, from close to 7 billion to 18.5 billion US dollar, while operating margins decreased by above 30%. This is the merger between L3 Technologies and Harris Corporation, which also dramatically increased the balance sheet, including goodwill. And this is a huge amount of goodwill, and there are always some impairments going on. And in 2022, the company acquired another company called Aerojet Rocketdyne for 4.7 billion. So L3 Harris Technologies is growing aggressively. They maybe should, because if you have a look at the market capitalization, you see that Lockheed Martin is much larger company compared to L3 Harris Technologies. L3 Harris Technologies is the smallest giant of these US companies in this business. What's interesting, if you look at or compare reported earnings and adjusted earnings, for example, for the year 22, you see that reported earnings $5.49 compared to adjusted earnings of $12.90. And you find these very numbers in the report, in the annual report, 549, 1219, 549 reported earnings, and this is the adjusted earnings. And here you see everything in between. And it's mostly amortization, integration costs for the merger which happened in 2019, and here impairment of goodwill. And what we know, now comes the good thing. All these impairments and goodwills is cash flow neutral. So you see it if you have a look at the operating cash flow, and you see the operating cash flow is very close to the adjusted earnings, not to the reported earnings. So adjusted earnings for me is what matters the most, and the cash flow, of course, and the free cash flow. I show you here, nicely still covers the dividends even here right now, last 4 quarters, and the situation should even get better in the near future. So dividends look safe. And now let's have a look at the fair value of the stock. We use the adjusted earnings, the average historic multiple of 60.9, which will be used to calculate the fair value, and which compares to, is right now 15.8 multiple. And now I show you the fair value. Here it is. We zoom in a little bit, and here you see that the fair value of the stock is $209 compared to $195. So the stock is undervalued, although it was even more undervalued recently, just 2 months ago, where the stock price was just close to $160. But we still have nice upward potential with an annual expected yield of 12% for the next 3 years. Annual yield, 3 times 12%, total yield 42%. So this is stock number 1, and stock number 2 is a little bit more peaceful, and it's Burberry. So it's luxury. It's a luxury brand, and here, just for comparison purposes, also other luxury brands, all these coming from France. Louis Vuitton, I think everybody knows, Kering and Hermes International probably also. What is interesting, what makes Burberry interesting is the stock looks very cheap. And you can see it here if you look at the multiples. The multiple based on adjusted earnings for Burberry is 12.4, and LVMH, for example, is 25. Just Kering is similarly attractively valued, or looks cheap, with the same discounts here. You can see fair value metrics here, and you can see that Kering and Burberry, they both look undervalued. We focus on Burberry right now, and if we look at the dividend, you see here that the dividend is 4.2%, and this is clearly above the historic average. You can see it here. And here we have a dividend cut, not only a cut, there was no dividend paid at all for 1 business year. This has to do with Corona, of course, an extraordinary thing. And here I just want to tell you that it's dividend, constantly growing dividends, or the dividend history itself is not as important in Europe as it is in the United States. So the mention of dividend aristocrat doesn't matter that much for European companies compared to US companies. For me, it's not a problem, because if dividends can be paid, dividends will be paid. If future is uncertain, like it was during the Corona lockdown, management is more careful and says, okay, let's skip dividends one time and continue how it evolves, and if things go well, again, we continue paying dividends. For me, it's completely fine. But everybody needs to decide that for himself. If you look at the free cash flow, for example, dividends would have been nicely covered in this year as well. But okay, management decided not to pay them anyway. Regarding management, we have a new CEO. He's called Daniel Lee. He's a star designer, and he comes from Bottega Veneta, Italian luxury brand, and he was very successful there as a manager, and now his job is to make the turnaround for Burberry. And if he succeeds, he will unlock a lot of potential. And we can see that if we use the fair value calculation for Burberry, you see here that it's not a company in crisis mode. It's just a company where the stock price dropped because latest news about China were not that promising. So the estimated expected sales, double digits, same store sales growth did not happen. The same store sales growth was sluggish, 1 or 2% only compared to 10, 11 or 12%, which was expected. So China business is really slow right now, and China is an important market. You can see it here. It's more than 22% of revenues come from China. But this is something all companies, luxury brands have to fight right now with. And now if we'll have a look at the adjusted earnings, fair value, then we see that we have a lot of upward potential. We have here annual expected yield for 2 years and some months of 29%, or total yield till March of 26 of 80% dividends included. This is really a lot. Even if it does not unlock fully this potential, you can make your own guesses here with these valuation lines. Or for example, that you say, okay, I'm already happy if the stock price until spring 26 moves around 20 British pound, then you still have an annual yield of 15.9%. So this is a second stock I wanted to show you, 2 potential dividend stocks on discount. So do you have our dividend stocks? Maybe I should have a look on, then drop a comment below. I will read every comment and maybe your stock will be analyzed next. Thanks for watching. Bye bye.